So welcome everyone to this session today, Venture Funding 101. My name is Beverly Crawford. I'm the QCT Executive Communications Manager. And before we start the session, we just have a little bit of housekeeping to think about. First of all, when we do Q&A, please remember to use the microphone. We are recording this, and we'd like to hear your questions. The next is think about silencing your mobile phones. And we're going to have a 10-minute break, so you'll have time to stick around and talk to people and things like that before your next session. And then the final thing is, if you could fill out the survey via your conference app, so whether you liked it or didn't like it, you still get entered into a drawing to win a smart TV. So with that, I will introduce our panel. Moderator today is Gareth Keane. He's our investment manager at Qualcomm. And then Karan Mahandru is general partner, Trinity Ventures. Michael Yang is a managing director of Comcast Ventures Technologies Incorporated. And Eric Zimitz, managing director of Granite Ventures. And with that, I'll turn it over to Gareth. Thank you.
Great, thank you so much. Just a bit of housekeeping from my side as well. Quick outline, we're going to get some introductions from the guys. They'll talk about their funds, what they focus on, maybe some background around themselves. I've got a list of questions or topics we're going to talk about for a few minutes, maybe 30 minutes or so. And then at the very end, maybe 10, 15 minutes of questions, if that's okay. And I would ask, when you start asking questions, try and be as general as possible. Don't have a very specific question about a company you're working on and how to raise funding for it. You can do that stuff offline. If you could have sort of very general questions about starting companies, anything you think might be more interesting to the general audience, that would be really helpful. So with that, I'm going to hand over to my good friend Karan Mahandru, give a bit of background around Trinity and himself, and take it away.
Sure. Thanks, Gareth, and thanks for having me. Can you guys hear me okay? All right, good. So as Gareth said, I'm Karan Mahandru. I'm one of the 8 now, general partners at Trinity Ventures. For those of you that don't know Trinity, we've been in business since 1986. We're currently investing our 11th fund, which is a $325 million fund. We're predominantly an early-stage venture capital firm. Most of what we do is Series A, Series B, and seed investments. So we're usually the first or the second institutional money into a company. The fund is roughly split half consumer and half enterprise. I'm on the enterprise side of things, and I lead our SaaS, big data, and cloud practice. I've been at Trinity for about 4 years. We started out and we did a bunch of retail investments. Actually, are probably one of the more famous investments that we've been part of are Starbucks, Jamba Juice, and P.F. Chang's back in the day when we started out. We've since moved away from a lot of the retail investments and now focus a lot more in cloud technologies, cloud infrastructure, a lot of developer-oriented platforms. We're investors in New Relic and Docker, which are probably the more well-known developer platforms. And like I said, we're investing our 11th fund, and I've been there 4 years. Prior to this, I was with another venture firm called Scale Venture Partners, which was a spin-out from Bank of America. I was doing more later-stage investments in similar categories there. And before that, I was on the operating side for 10 years and did a bunch of work. Actually sat in the cubicle right next to Gareth in 1999. This is a long time ago now. We're dating ourselves. But spent a bunch of time in product development, chip design and layout, and then marketing and sales.
Great, thanks, Karan. Eric, do you want to give a quick overview?
Yeah, sure, thanks. I'm Eric Zimitz. I'm with Granite Ventures. You know, at Granite, we trace our roots kind of way back to the early history of Silicon Valley. We were a spinoff of Hambrick & Quist, which was one of the first investment banks to really identify the opportunity in Silicon Valley. So, you know, we were investors or bankers to some of the early companies like Apple and Genentech, Amazon. So, you know, our roots go way back to the early days of the Valley. More recently, we focus on early stage IT investments. You know, the big themes we focus on are things like enterprise software, which is kind of cloud computing largely. Look at digital media and mobile. Obviously, wireless is another big area for us. You know, some names, kind of more current names. Anaplan is a emerging leader in enterprise software, SaaS software. You know, for those familiar with Walking Dead or fans of Walking Dead, Telltale Games is a digital media company that's doing quite well. We're invested in that has that online and episodic game around that franchise. On the mobile side, it's a pretty broad horizon now in mobile, right? It really touches everything. But our investments go from consumer applications like Smule, which is a music-based application for smartphones, to hardcore hardcore network infrastructure like Fastback Networks, which is doing a very high-end LTE data networking solution.
Great, thanks, Eric. And Michael, maybe a little bit about Comcast Ventures.
Sure. Michael Yang, Comcast Ventures. We're a 15-year-old venture fund affiliated with Comcast Corporation. All our funding comes from them. We are a multi-stage fund, so in every given fund, we'll do as many seed stage deals as we will kind of mid-stage, later stage opportunities. Focus on general technology, and within technology, it could be hardware, it could be software, it could also be services as well. Half of our investments are on the consumer side, half of the investments are on the enterprise side. And I myself focus primarily on healthcare tech as well as Internet of Things. But we look at enterprise software, storage, security, cloud, ad tech, media, gaming, e-com, you name it. Anything except for biotech and life sciences.
Great. Thank you, Michael. And actually, I should probably give an overview of Qualcomm Ventures just to give you guys some insight. We're the corporate fund of Qualcomm, invest off Qualcomm's balance sheet. We deploy money into something north of 30 startups a year, all the way across the mobile ecosystem, from very low-level technologies like semiconductors to the top end of the stack, application software services. Some of our big hits in the last couple of years have been companies like Waze, a very popular traffic and mapping application, which a lot of you, I'm sure, use on your cell phone to get around San Francisco. And then also companies like InventSense that IPO'd 2 years ago, kind of around sensors, accelerometers, gyroscopes, inertial sensors in the phone. Great. Thanks, guys, for the introduction. So I've got a bunch of topics. We're going to go through them one by one, hopefully get a bit of discussion going, hopefully some controversy. And then we will get through as many as we can and then open it up for questions with about 10, 15 minutes left. So I think first question, Karan, if I can start with you. For people who are thinking of starting a company, what do you, as an investor, really, and your firm and your team, what do you look for in a pitch or an idea? What's kind of the key thing that will catch your attention?
So I guess from our perspective, and this is not just specific to Trinity Ventures in particular, I would say any fund that's sort of our size, and size is a good way to delineate what different firms look for, but for a $300 million fund, where we invest in a company and take, say, call it between 20 and 30% of the company in the first round. You want an idea that has the legs to get to $1 billion. Not a lot of them get to $1 billion, but if you don't go into the investment thinking that it could be a rather large market that you're targeting or something that you're creating, it just does not justify it from a returns perspective. Now, we've done really well with investments that have returned a lot of money to us and created some great relationships along the way that didn't exit for $1 billion. But at the outset, I think the market is one thing that we just don't have any control over, just to a large part. So that's something that we want to make sure that exists, or is in the process of being created to a large extent. That's one thing. The one thing that I personally look for is the three things I would say I frame in my mind are answers to the question, why anyone, why you, and why now? I think if you can answer those three questions in a credible way, it'll make the reception of your pitch a lot easier for the investor to understand. And this is the way I sort of evaluate my own investments. And why anyone is essentially just, why is this market even worth attracting or worth targeting? Why you? Is there something differentiated about the team that makes you that much better than the next person that's trying to attract the same market? I think that's important. And I think the why now question is becoming a lot more important. That's the third piece that a lot of people forget. And in our business, being way early is almost indistinguishable from being wrong. And so until you get the why now part right, a lot of times you might get the first two right and not the third one, and you'd still fail. So those are the three things that I would look for amongst a whole bunch of other ones.
Cool. Michael, Eric, anything to add on top of that?
I disagree with everything you said.
Nice. Controversy right there.
What a controversy. No, I mean, that was spot on, really, right? I mean, you could distill it a lot of different ways. I mean, we always talk about, we're looking for great people, with, addressing a big market opportunity and have a great idea, right? Which often means you have some competitive advantage that you're bringing to the market. So, and at that point, it becomes a matter of, well, it depends what space you're in, right? A lot of things start to, the importance of different elements vary depending on the market you're in. Is it a consumer market? Is it an infrastructure play? So you have to weight the business you're in, the competitive landscape, and really try to balance it out and decide, what's worth pursuing and what isn't.
Cool. Cool. Michael, any thoughts on this?
The only thing I'd add is on the notion of idea, because I think we focus on market and team. Ideas can change, so we don't get hung up on the idea. So if a founder or team is really fixated on a particular idea, that may be appropriate here and now, but things change over time. If they can't get off of it, then you're kind of stuck. So we try not to be too gimmicky on the idea side, really look at large enough markets where things could evolve, and then a good enough team that could swim in it.
Cool. So that's sort of, I guess, an overview of a great pitch or sort of opportunity. How about a founder? What would you look for in an ideal founder if you had to sort of pick a couple of traits, maybe even one trait from you guys? It's great to have a great idea, a great market, great team, but for an individual, a CEO who's coming to you with an idea, what are you looking for in that CEO?
I would say, listen, founders are critical, right? And so, from my perspective, I want a founder that can be with the company through its entire life cycle, right? I don't take, the idea of replacing founders is not something I take lightly, or I'm sure anybody takes lightly. It can be very disruptive to the enterprise. The founders bring the culture, they bring, everything to the table. So to me, that's probably the number one element, right? Now, sometimes founders show up and they raise their hand and say, by the way, I'm not CEO. And then you have to think about, well, who is the CEO, right? Or are they temporary CEO? But, they're going to play some role. And it might be CTO or whatever. But, for me, I think that's the most important thing is to make sure you're working with a founding group that can take the company the distance.
Cool.
I guess from my perspective, I would say the two things, we're in the pattern recognition business at the end of the day. And if I were to look back at our history and present, there's a couple things that stand out in terms of traits of a founder that have been somewhat of markers for long-term success. And those are, the first category is sort of just passion for the space that they're investing in, their time, money, energy, sweat. And that's a big piece of it. I think if they're not passionate about it, if they don't viscerally feel the pain that they're trying to solve, it becomes really hard to be emotionally attached to this project that's going to be a long ride, and even longer with a VC sitting next to you. So that's number one. I think the second part sort of dovetails into what Eric was saying, which is it's not so much that from my perspective, not so much that you think you're going to be there with the company for the long haul. It's more that you're self-aware about yourself. And that sort of comes in various flavors. A lot of founders know that they're just great at product and tech, and they'll always want to be in product and tech, and they're totally fine with bringing a new CEO in. And some founders know that they're just great at sales execution, and they want to be in the go-to-market side of things, and that's fine too. To me, that's an attraction for a founder in any category. If they have a high degree of self-awareness and a passion for the space that they're investing in, that's usually a sign that this company or this product or this team will actually do well. So those are two things that I look for.
Cool. Michael, anything on your end?
Two things I would add is the relationship between the founder and the investing partner on the VC side, because as the adage goes, you are getting married. So if you run a shotgun process, you really don't know the VC on the other side, and vice versa. That's a hard way to kind of start a relationship, and it's going to be a multi-year relationship. So,
and a lot harder to get divorced.
Right, yep. Right. So we look for those interpersonal dynamics and chemistry, frankly, on an individual level. I think the second thing is there are a lot more startups. Let's just be honest. The supply of startups and deal flow that we all get to look at these days seems to kind of grow by leaps and bounds in recent years. So, and any given space is a lot more crowded, it seems. A lot more companies doing the same stuff. So a founder that can naturally tell a story, has marketing chops, has this ability to kind of sell and differentiate kind of what their company is doing is great, not only for the business but also for recruiting and bringing people into the company. So we look for natural storytellers increasingly.
Cool. I'm going to riff off one of the comments you made just there. You talked about that partnership between a VC and an entrepreneur. So kind of flipping it on its head, what would you recommend for these guys who are maybe thinking about raising some money? How do you find the ideal VC? How do you find the right VC for you? A loaded question right there.
Listen, frankly, I think the relationship probably is a little asymmetric, to be quite honest. So there are a lot of entrepreneurs who might really like to shop for the ideal venture capitalist, but what they're really looking for is somebody that'll give them money.
Yeah, looking for a check.
So
right.
Yeah, I think that's probably covers a lot of the frontier, right?
Okay.
But listen, personal relationships are personal relationships, right? There's different things that are going to make people click. And by the way, most companies are funded by more than one venture capitalist, certainly over the life of the company. So, the dynamic between the investor base or the investor group and the entrepreneur is going to change over time. So something else to consider.
Cool. Any thoughts, Karan or Michael?
Yeah, I would just add a couple, I guess more than a couple of things, but I would say for the most part, I would agree with everything that Eric said, and I think relationships are a big piece of it. I think the one thing I always tell founders to do is make sure that whoever you pick at that early of a stage, because you're right, I mean, different stages, you look for different things than an investor. But when you're starting out, when you're looking at a seed round or a Series A round, if you have to educate your board member every board meeting about the space that you're going after and the market and how it's evolving and who the players are and who to compete, that's just a waste of everyone's time. And so find somebody that at least understands. They'll never understand the space as well as you because you live and breathe it. But domain expertise is a big thing in terms of picking a Series A investor. And make sure you talk to other CEOs or other founders that investor has funded in the past, just to get a sense for what their style is. In our business, I would say, and there's a healthy percentage of VCs that helicopter into board meetings every once a month and then go away for 29 days and come back again without having read your board deck. So just be very cognizant of behavior and interactions like that, which is going to hold you in good stead, because at that stage, it's not a straight shot to glory. You're going to go through ups and downs, and sometimes you're going to have to revisit things that you decided at the last board meeting. But unless somebody has a visceral sense for how markets are sort of shaping, and this goes back to the point that was made earlier around market and team is a lot more important than the product, because the product will pivot and change. But unless you and your board member or your investor are on the same page and understand what's happening, it'll be a pretty messy
I mean, that's a great point, by the way. I mean, I'm not, without naming names, right? I can,
name some names.
Yeah,
Name some names.
Circumstances where you have a company that 3 years into its history, board members would show up and every month ask, wait a minute, are we on unlicensed spectrum or licensed spectrum? It's like, some of that fundamental, which is, had to be known on the investment, kept cropping up as an issue, 3 years later. It's just, you're right, it's remarkable how little attention some people pay to their investments. And sometimes probably because they're just so stretched too thin. I think one other issue worth pointing out is one thing that's I'd say it's becoming trendy, but you're starting to see some large venture firms practice this idea of partners that go out and get the deal, the hunters, and then once they actually land the deal and make the investment, they have board partners that come in post-investment. So, it's a little difficult to know who exactly you're going to get when that dynamic's being played. You could ask, I guess, but
you
it's
never
hard
know.
to build those relationships when, the person, it's a little bit like an investment banking relationship. The person selling you on the deal isn't the person that executes the deal.
Michael, any thoughts on that?
Just do your homework. It's all about preparation. I mean, if you're in a fortunate position where you can actually consider multiple VCs, reference them. They're sure as heck referencing you as they're kind of going through the process. And I think, the most criminal thing you could do is go to a consumer-oriented VC and pitch them an enterprise deal and vice versa, because it really shows you've done no homework. As a venture group is a partnership or collection of a lot of people with different focus areas and preferences, and you got to sift through it. I understand, to your point, there's information asymmetry, but it's not too hard with a few phone calls or emails to kind of figure out who's interested in what, or at what firm should you go to for this kind of an idea.
I mean, one thing I'll add to everything is, the times have changed, and so what 10 years ago, what the mode of engagement was between a VC and an entrepreneur is quite different today. Most deals are not happening inside the halls of a venture capital firm. A lot of them are happening in coffee shops in San Francisco, well before a term sheet has ever been signed. I'm in multiple meetings in a win scenario where an entrepreneur looks me in the eye and says, what else do you bring to the table besides money? Why should I pick you over 4 other VCs? And I think that's something that everybody in our business is very cognizant of, and you should be as well, where I think you have the luxury, even though there's a lot more startups in every category, there's also a lot more money flowing into the system. And so there's a lot more VCs with capital. So I think it sort of cuts both ways, and you should take advantage of that and have those conversations. And I think those are happening already. So it's not something that's new. And in fact, to me, it's a sign of, okay, if this is how I'm being evaluated, then and I'm sure I trust this person to be able to hire other people and raise more money from other VCs and things like that.
Right, it's a great point. I mean, by the asymmetry reverses on occasion, right? Where there are certain deals where there are far more venture capitalists that want to invest than they are capacity. And in those situations, I think the entrepreneur has a lot of opportunity to scrutinize and shop and pick and choose.
Interesting. So, this is kind of riffing on this question again. There's 2 corporate guys in this panel and 2 institutional guys. I'm going to open this up to you, Karan and Eric. Corporate versus traditional institutional VC. What are the pros and cons of corporate money?
I'll let you go first.
It's a safe space.
Listen, I'm a big fan of corporate venture capital. There was a period of time, 8 years ago or so, when venture capital was a little toxic, right? And people were diving under their desks, and the LPs weren't interested in the category. To some extent, we're still seeing funds retrench, but the one group that was stepping forward in that were the corporate venture firms, and the ones that do it well have, I think, really established themselves in the marketplace. I think not just because they're here, but Qualcomm and Comcast have really, I think, they're in that elite tier of corporate venture firms where they do a great job. And I've worked with both firms on multiple deals, and they're a pleasure to work with. And increasingly, bringing them in early, right? The old model used to be, we'll get some institutional guys to do the A round, and then we'll get the dumb corporate money to come in and sort of price the latter rounds. And that's not the dynamic anymore at all, right? A lot of times, and you guys can speak for this yourselves, but I mean, these guys are getting in there early. We hear about the seed investments that corporate venture guys are making. They could bring value at a very early point in the company's life cycle, and I think it's really critical. So, a lot of times I'll look at a deal and I'll think to myself, who's the corporate venture partner I should be talking to here, right? And when should I get him involved? And a lot of times it's sooner versus later.
Awesome. Your check is in the post. Thank you. Any thoughts, Karan?
No, I mean, I was going to say, you asked pros and cons. So pros, it's undeniable that the corporate heft that you get along with the corporate investor when it comes to sales and marketing channels, when it comes to development resources, when it comes to just general exposure to the market is unquestionable. So, I mean, I think that's something that even VCs would be hard-pressed to compete against. So that's definitely a positive. I think on the con side, what I've seen is there are 2 flavors of corporate investors. One where they will only invest in things that are very strategically important to the business that they're operating in. And second, ones that operate as actual VCs, just sitting inside a corporate umbrella, investing out of the balance sheet as opposed to like a venture capital firm raising funds from outside money. So, and I think that, in those 2 cases, I've seen terms of engagement being very different. And for the most part, what I've recommended my companies and our companies to do is, look, corporate money is actually great. For the most part, we would invite them into some rounds where we think there's a strategic reason to do that, as long as, and this is a big one, as long as there are no terms in the contract that either mitigate or preclude you from being able to exercise your exit options without giving up something in return. And that's the only big one that we actually care about. Besides that, everything else is positive.
Yeah, Michael, any comments from you on the Comcast side?
I would agree with that last comment. Is critical because I think there's one company in the South Bay in particular that's acquisitive, but also does a lot of investing. They don't. Most of their investments are with the eye to potentially acquire down the road. So if you end up with them in your cap table, you just have to be sensitive when you're managing an exit process. And we have a few situations over the years that we've had with them on that front. But again, I go back to do your homework, right? Most of these groups, they've either been around or just launched with fanfare. You can talk to plenty of portfolio companies or co-investors to get a sense of what their behavior is, what their motivations are, how are they structured from an economics perspective, a decision-making perspective, all that kind of stuff. And then you'll know where their compass is really set.
Yep. Yeah, and as to balance my positive comments, I mean, when corporate venture is bad, it can be really bad, right? If you're the entrepreneur, right? When you get the buy high, sell low mentality, right? Some corporations pile in when the market's hot and they think they need to do this, and they'll restaff a couple of people to run a venture program, and when things cool off, those folks might rotate into some other job, and somebody else ends up with deals they've not invested in. They don't feel ownership, and the next thing you know, the VP of marketing is getting calls in the middle of the night saying, "Hey, we got the C round coming up. What's happening here?" Right? And it could be a mess. So, pick wisely, I guess, or rely on your other investors to help you pick wisely, because there are folks that have history and there are folks that are not as experienced.
Cool. So kind of other end of the spectrum then, there's been an explosion really in the number of accelerators and incubators, not just in the Valley, but worldwide in the last sort of, call it 3 years, maybe 5 years. Some great examples like Y Combinator, Techstars. What's your take as a venture investor? Are these helpful to you as an investor? Do you find it sort of changing the landscape at all? And then from an entrepreneur's perspective, are these sort of value add, value destroying? Any thoughts around that? Michael, you want to kick us off?
Sure. So clearly an explosion in incubators and accelerators. I would say 5 years ago, we would try to go to the demo days and engage with them. I'd say now we choose not to go because it's really set up to be disadvantaged to the investor because it's a whole manufactured, manicured kind of process. And the terms aren't as friendly as they used to be. The ability to build a relationship with the founders are you have less time to kind of do that, and it's just kind of ready, set, go. Where we do still spend time at the incubator accelerator level is vertical specific ones. So in healthcare and IoT where I spend time, there are newer ones that are rich in terms of quality of entrepreneurs, the programs that are being offered. But the same thing, do you need to go to the 7th incubator accelerator in the healthcare world or the 5th in the IoT? Probably not. So you got to pick and choose wisely. And I think the advice to the entrepreneurs is you can ask within either a vertical or general purpose accelerator, what are the good ones worth going to, and which ones you might be better off kind of bypassing and kind of doing your own thing.
Cool. How about you guys, institutionals? Any thoughts?
Yeah, I think they're great in general, right? I mean, the more opportunity to fund startups, it's just selfishly from our perspective, it's good to give these companies seed capital to get their ideas percolating a little bit, maybe get some market traction. It's easier to evaluate when they're a little farther down the lifespan curve. So that's good. Increasingly, there's a dynamic I think too where some of these seed deals, which may not involve accelerators, early stage venture firms are participating. We're doing a lot more seed investing than we have in the past. It's a little different than the accelerator thing, but that dynamic of getting in early, I think, is also positive, and it's also a good thing. The other side is it is a supply demand reflection, right? I mean, the idea of early stage technology investing is, bubbly right now, and there's people that want in, and this is an avenue by which the capital's finding startups. It's not all going to work, and there could be a time down the road when people don't want to do that anymore, and you might see a lot of these things go away. So, cycles come and go. So, right now, it's as an entrepreneur, I definitely take advantage of it if possible.
So make hay. Yeah, gotcha.
Yeah, and my comments are pretty much aligned. I would say, are they good? Are they bad? My answer is yes. It's like asking, are VCs good or bad? There are good ones, there are bad ones. I think the sign that they exist is more a symptom of the markets that we're in. And almost every time, in history, if you go back and look at it, when markets are buoyant, and that is the market that we're in right now, money just sort of kind of flows from the public all the way down to private. And the public investors start investing in late-stage investing. Late-stage investors go into mid-stage. Mid-stage starts going into early stage. And I think it's just been sort of happening for a few years now, where what used to be the Series A's of the last 5 years, I wouldn't say the last 5 years, but maybe 5 years back, are now seed stage, seed rounds. And so there's just an explosion of capital. And because markets are getting ridiculously competitive and buoyant, all the capital just moving from the right to left. So that's part of it. And on the accelerator standpoint, we work very closely with a lot of the accelerators. There are good ones, there are bad ones, there are a lot of them. In general, to Eric's point, I think the mentorship and all of that stuff that they promise you is actually quite good for entrepreneurs that are doing this for the first time, because the other thing that's happening is the quality of and the type of entrepreneur has changed quite a bit. It is not that 50-year-old executive that has had 3 hits before and now starting a 4th company. It's a 24-year-old guy who just coded something on AWS and wants to make a company out of it. So there's a lot of mentorship that happens with these accelerators that I think is all net positive for the entrepreneurial ecosystem. What's not positive is that it's gotten to the point of this fit and polish and being able to present to VCs when there's really no the emperor has no clothes sometimes.
No real business model, no real
yeah,
product,
there's
right?
not real thought to building something deep and impactful. It's more about how do we polish a 90-second demo so that all the investors go in a frenzy to try and fund it. That's the part that I don't really take very,
You don't like?
Yeah, that's the part that I don't like. But in fairness, I think some of them have done really well, and they've had mentored entrepreneurs really well. I mean, Dropbox and some of these companies came out of there, and they still hold Y Combinator, for example, in high regard. But I think you'll see some correction, just like you'll see correction in other parts of the capital ecosystem as well.
You know, I got to make another point too. You know, the financial industry, which we're all part of, is very impacted by regulation, right? I mean, but you know, if you've read the recent Michael Lewis book, right, Flash Boys, you get a real sense of that, right? Regulations all around, trying to protect small investors, had the exact opposite effect. And I think what you're seeing in early stage investing is really a reaction to some financial regulations that really shut down NASDAQ as a capital formation vehicle. So once upon a time, companies were able to access NASDAQ, raise capital at an earlier stage, and the ability to capture value in these growth companies was there for the common investor. It's not there anymore, right? Companies don't go public until they're sizable, established. You know, it's sort of a, you know, end of you know, rather than the beginning of the race, it's sort of the end of the race a lot of times by the time these companies go out. So and that's just sort of created a pent-up demand, I think, for early stage technology investment that's finding itself expressed in different ways. And I think these sort of vehicles are part of that.
Interesting. So that's kind of an interesting segue. The question I had next on my list, which kind of relates to all this, is do startups even need VCs anymore? You know, with sort of angel list and accelerators and incubators at the front end, all these sort of, you know, public market guys moving into late stage private investing, are we getting squeezed in the middle? You know, I think, is there a need for VCs to reinvent themselves, reinvent their models? Is that what's pushing people earlier, later? Any thoughts around that?
I mean,
it might just be yes.
Yes, I think I think venture firms, like anybody else or any other business, constantly needs to reinvent itself. Cool. I think there is definitely a press from both sides, where you know, you have a handful of, you know, venture firms that, you know, I guess in the, you know, when they formed in the 70s or 80s, used to be kind of small, you know, 6 or 8, maybe a dozen partners, are now, you know, hundreds of people, right? Yeah, they're very large, they're very diversified, they'll do everything from private equity down to seed investing. And you know, some of them have done quite well and are definitely, you know, kind of established a different, you know, different type of venture firm. And you have all this activity at the bottom that you've mentioned, if you will call it the bottom, right? Sort of the, I don't mean that pejoratively, right? The, you know, the accelerators and seed investing, and, you know, that I think are creating some pressure for kind of the mainstream venture firm. And a lot of them are adapting, you know, which is smart. You know, they're focusing, they're becoming maybe more vertical focused. You know, a lot of we touched on this before, a lot of the responses to really focus on serving the entrepreneur, right? And putting that out as a means of differentiation. So yeah, people are reinventing themselves all the time, and I think that's just going to continue.
So my glib answer is, I don't think you need venture to start companies, but you need venture to scale companies.
Okay.
And in fact, I was having a conversation on the ride here with one of my other CEOs. We were talking about fundraising and things like that. And you know, what I told him was, look, surviving is a big part of being successful, but surviving alone is not winning, right? And I think some of these sectors, I invest a lot in software as a service, for example, and you can get to $1 million in ARR and annual recurring revenue in a SaaS company without any capital raised. But in multiple verticals, and then this has held the test of time to some extent, you need 30 million to get to 30 million in ARR. You need 90 million to get to 90 million in ARR. And so to scale to those kinds of levels, you need capital, and that's where venture investors come in. Now, there's always exceptions to the rule. You had Viva Systems that went public with almost no capital raised, 4 million, because they were so highly optimized to a vertical and were so valuable to that vertical. And then you got Box on the other end that's raised a ton of money. That's sort of thrown off the economics in terms of how much capital you need to raise, but they're going after world domination in cloud storage, if you will. So there's always those two ends, but I would say for the most part, yes, you can spin up a cluster in AWS and start generating revenue as a developer, and you can get to some level, but at some point in time, you're going to need venture capital to scale that company, and that's, I think, we're sort of a necessary evil in that regard.
Got you. Just going to shift gears a little bit and talk about sectors. So any business model sectors you guys are very bullish on, very bearish on? You know, what do you think is exciting, and what have you seen way too much of and you think is sort of overbought right now? Michael, any thoughts around this?
I'll give bearish because I'm you know, that's more
of a bear.
interesting,
That's your
probably.
personality. Yes.
No, you know, Gaming, I'd say we're fairly bearish on, whereas a few years ago that was probably all the rave, and every firm probably had a couple individuals focused on it. I think the public markets haven't supported it. There aren't that many Minecrafts out there. So I think an interesting tale is look at the great talent that has gone into the gaming industry over the last few years. They're not choosing to stay in that industry. They've moved on to other walks of life. So that one I'll call out.
Cool. How about you, Eric?
Well, I'll throw something not really radical, but one space we're really intrigued with, we've made no investments in, but it touches, it's sort of one of these, touches everything, is Bitcoin, right? Or call it cryptocurrency. It's just a fascinating opportunity, I think, and touches, shouldn't back up, really the concept of the blockchain is really the fundamental technology component of cryptocurrencies. And having this distributed authority could be very impactful to a lot of different business segments. So we spend a lot of time thinking about that and looking for opportunities around the edges. The market itself, or the deals themselves, have gotten kind of too hot too fast for us in some respects. So a couple of companies have stood out and attracted large amounts of venture capital at very high valuations, which made us pause, but not to the point where we haven't stopped looking. We think this is a trend that's going to play out over quite a long time.
Cool.
And from our perspective, we're looking at these companies that we invest in on a 10-year horizon. So, in essence, what we look for hasn't changed in a long time, which is looking for secular trends that sort of transcend any fluctuations in the capital markets. At the end of the day, the electrons don't know that the markets are up and down. So we've been very heavy in cloud infrastructure, so all the way from infrastructure as a service to platform as a service to SaaS. We've invested up and down the chain, and we continue to be very aggressive in that regard. We're spending a lot more time around mobile commerce, which is a new segment where this iPhone and Android phones as a platform to engage, amplify, and then do transactions. I think it's a pretty big thing, and it's more on our consumer side where we're leveraging mobile as a vehicle for services, mobile service economy. And that's where we're spending a lot of time. On my end, I'm spending a lot of time around sales and marketing focused SaaS, and that's more realizing the trend that's happening, which is that the chief marketing officer's budget is almost going to eclipse the chief information officer's budget in 2016. And so that there's a lot of tech that's now in the hands of a marketer that doesn't need an engineer to go instrument. So that we're spending a lot of time investing in and around that trend. And we don't do a lot of things, not because we're bearish on them or bullish on them, because we just don't have the wherewithal to do everything, and we don't understand some of it. So we don't do any healthcare investing. That's just not our forte. We know where we're good at. We know where we don't know anything. We started looking at Bitcoins. We have not formed an opinion yet, so I will refrain from standing on one side of that argument.
It's like I hear that from lots of people. They're really interesting, but we have no idea what's going on.
Yeah.
Okay, we've got about 10 minutes left. If you guys are cool with it, I'm going to open the floor up, let you guys ask some questions. Does anybody want to stand up with the microphone, which is here in the middle of the floor, and maybe take their turn? Cool, take it away. Maybe just introduce yourself and give us some background.
My name is Rahul. I work in Qualcomm's strategic marketing team. Okay. My question is basically more related to semiconductor and hardware solutions. Do you know any pockets of industry or like segment where entrepreneurs can go and start company and get VC money? A lot of money going into software, SaaS, and all those things, but not a lot happening in this sector from the VC side. So what's your advice, and give some idea about the market?
It's very true. I don't think there's that many venture funds funding semiconductor startups anymore. Maybe around hardware, you might be able to find some guys. I mean, certainly connected hardware. There's a couple of really interesting accelerators even here in the Valley, like Lemnos Labs. Hardware companies go through Y Combinator. But semiconductors, I don't know anybody who's actively spending a lot of money in semiconductors right now.
It's a very difficult space now, of course, for the obvious reasons that you know. There is a big issue, though, which is where's the innovation going to come from, right? You bake it all down at the end of the day, and it would be good to see innovation at the semiconductor level. There are a handful of companies that actually do some of that, but as we all know, the bigger companies get, the less innovative they often are. The present company accepted.
Thanks so much. I will say, Qualcomm Ventures, we still do invest in semiconductor plays. It's not a huge amount of the dollars we deploy, but we always are open to investments in that space.
Just to follow on, sorry. With IoT coming probably the next frontier of hardware, I guess just probably confirmation or is it more of a solution level play where you don't see any semiconductor innovation, but mostly optimizing the solution or hardware?
So just the question, just repeated for the AV, it's around IoT and whether there's opportunity at the semiconductor level in IoT or if it's going to be more of a solution level play. I can certainly give you my perspective. Most of the interesting IoT devices and plays that I see there's software wrapped up in hardware. You know, it's like a plastic shell, some commodity semiconductor on the bottom end, but it's mostly software development.
Yeah, that was actually, I was going to mention that as a reply to your first question, which is that even the hardware companies that you can point to in the South Bay, if you actually dig into the covers and look at where the R&D dollars are going on their income statement, a majority of that is actually going into software and firmware. And the fact that it's wrapped around sheet metal, or the fact that it's put in a package, that's just a means to an end, but the innovation is happening in software. And I think that's one of the trends that is, again, here to stay, which is software is encroaching upon hardware, and even hardware companies that are parading around as hardware companies actually have a lot of software IP that's built in-house. So, and for us as investors, it's not so much, you evaluate semiconductor as an industry and say, well, it's a good or bad. And yes, there's a lot of challenges, but the fact is that it's the opportunity cost of $1, which is, if we put one in semiconductor, we're not putting one somewhere else where we potentially see a lot more opportunity on the other side. So that's more of it than people are bearish on semiconductor, which is also the case. But
Hi, Mike Stipe with Persistent Systems. My question is for the two corporate guys on the end. Traditionally, corporate ventures have only done more late-stage funding. Do you see that trend changing and doing more early-stage investments now going forward?
Sure. I mean, I think both of us here will point to the fact that we run active seed investment programs. I think we do. Qualcomm Ventures. We do 10 to 15 seed deals a year, sub $1 million. I know Comcast, you guys are pretty active as well. Michael, you can sort of throw some stats out there.
Yeah, I think it just depends from organization to organization. You know, we probably do half a dozen, and we have a certain dollar amount and allocation per partner. But tying that theme to the earlier question on incubators and accelerators, you also see a lot of corporate-sponsored incubators and accelerators, which are effectively seed programs as well. Yeah. So, again, just depends on the sponsoring organization, what their appetite is.
And I think it's a reflection of sort of the challenges that some corporate investors see in getting into later rounds. A lot of the more exciting deals, certainly in the Valley, if you're not there from seed or certainly Series A, it's very hard to get a seat at the table in Series B or Series C. So I think that's driven a lot of it. It's being driven by circumstances. Yeah. You're welcome.
Just following up on the point earlier, I thought it was a great point about getting the VC's attention from the standpoint of being able to answer why now, why you, and why your product, and things like that. Is at some level that's pretty self-evident. But I'm curious if any of you folks can provide an example of somebody who answered those questions really compellingly, and kind of how those answers struck you folks to really look at that company.
Yeah, I mean, I can give you a few examples because it's something that we look at before making any investment. So I can go through my entire portfolio and talk to you about it. But as recent as a month or a month and a half ago, I just recently invested in a company called Boomerang Commerce, and what they do is they allow you they do dynamic price optimization for large retailers based on whatever business rules you have. So a Sears or a Nordstrom or whatever for online commerce. And essentially what they do is they take all of your SKUs and all your inventory, they scrape the competitors' websites, and they figure out what you should be pricing your product at that instant relative to your business goals, which could be revenue, margin, or market share. The problem's been around for a long time. It's a very, very difficult problem to solve. It's a big data problem. It's machine learning. It's predictive. But you can solve all of that. I think the why now question there was particularly interesting because if you look at what's happening in the market, if you look at Home Depot and Walmart, all these sites, they on average change the pricing on their inventory on their website once a quarter. And if you go to Amazon, actually I should ask people, at what frequency do you think Amazon changes prices on their websites?
Every minute.
It's once every 15 minutes. And so you're competing against a world where Amazon's changing pricing once every 15 minutes, and you're changing once a quarter. So there was a big need for something like that. But the why now question was more interesting because why is it more pertinent now? It's because people have iPhones. You'll be standing at a Best Buy looking at a TV, and the first thing you'll do is you'll pull up your phone and see what Amazon is selling it for. And that's precisely the reason why something like that needed to exist today, because the cost of price comparison has gone to zero because of the phone. And that why not question becomes really pertinent in that environment. Otherwise, it's not that big of a deal. So does that help?
Yeah.
Okay.
Good. Thank you.
So this is probably a more generic question, but you can answer each how you deal with this. You must be getting like hundreds of requests or introductions or whatever for new deals or investments. How many do you get, and like how many do you pick out of that?
Ooh, okay, loaded question. I'll let you guys.
I can tell you, I'm a pretty analytical guy. Last year, there were 1,100 companies I met with in the year, and I funded 4. So that gives you a sense for how the funnel converts.
Yeah, sounds right. I'm not as analytic. I don't have those numbers at my fingertips, but that ratio feels about right.
We use Salesforce.com ourselves to kind of track and log everything, so I think it helps. But I know I took 250 meetings. That doesn't include how many came in to get to 250 meetings, and only funded 1.
Yeah, so you can see the odds are not in your favor.
You can't be rational if you're an entrepreneur. That's the prerequisite.
You look at these numbers, you go, 1,100? That's easy.
Hi, Andrew from Apex Labs. There's this notion that venture capitalists always talk to each other behind the scenes. I guess the question to you guys is, how much do you guys actually talk?
I don't know. I think, most of us know each other. It's very much a relationship-driven business. So I think, coffee meetings, there's always conversations going on. If somebody's working on a very interesting deal, though, they tend to guard that stuff, to certainly be my experience.
Yeah, it depends on the context. If it's an active deal with co-investors, of course you talk all the time in regard to that. If it's sort of a deal when I say active, I mean when you're already invested in, right? If it's when you're evaluating, it depends, right? You don't always know who else is looking at it, right? If the entrepreneur, I don't say plays their cards right? They don't need to disclose who's involved. Now, sometimes you get together and you end up sharing names, and you'll find a common point. But I don't know that it's a big factor that would impact the entrepreneur in a very significant way.
It is a fact that the world is smaller than you would think, and so people do talk, and most people will probably know about you before you think they know about you. And from our perspective, we're all friends until we're not. So that's essentially how it works. We'll talk about everything until we start competing on a deal. I remember when we funded Docker, which used to be .cloud, back in 2010. I was in San Francisco at the entrepreneur's office at 1 o'clock in the morning fighting against another venture firm that was trying to do the deal. So at that point in time, we're not talking to each other. But before that, we should talk about how we think .cloud and Docker could evolve into being, a great technology. But that's the reality of the business, really.
Thank you.
Hi, Kurum.
Sorry, it's the last question, just in case anybody's wondering.
Make it good.
Make it good. Yeah. No pressure.
So
no pressure.
Pressure's on. General question, Will, but is the trend in the VC industry moving more from pre-seed to post-seed companies that have some traction going? Are those more attractive? Or what I'm trying to see is what's the ratio where in your selection process where going with pre-seed or a company that already has something going?
Mm-hmm.
I would say if we're looking or contemplating a situation where we know the founders, they were either in our portfolio previously or they're individuals we work with, we'll go more on the limb where it could be concept, they haven't done anything, there's nothing launched or to look at. If it's a newer space or folks we don't really know, it's hard for us to get a sense of them, then we would be definitely looking for traction. And then there's some spaces where it's hyper competitive, right? You could quickly look and realize there's 5 companies. Then we're going to want to meet all 5 and figure out who's furthest along, and that's the one we'll probably try to move on.
Right. I mean, that's a good way to put it. It depends largely, right? But I think what you're pointing at is the trend towards how easy it is for startups to start up, right? How quickly things can get going, and you don't need to raise $5 million and start handing money to Cisco and handing money to IBM, and you could spin up your business very quickly on the cloud, and that's definitely made it a little easier for venture firms to demand some level of advancement, achievement, in the startups before they write the checks. 10 years ago, almost every deal we did was people showing up with PowerPoint slides and talking about the business they're going to form, and and you wrote with some other co-investor, you invested maybe $8, $10, $12 million in the deal, and we don't have to do that as much anymore.
I'll add one thing, which is, and this is an important point that I tell early stage entrepreneurs. The answer to your question is yes. So in general, you have to show a lot more traction today than you did earlier, no question. There's two caveats to that. One is what traction means for your business in your sector is quite different relative to something else. So like what traction in a developer platform means versus traction in a SaaS business versus traction in a Internet of Things, but it might be quite different. So you need to understand what that traction is. The second thing I will say is no matter what sector you're in and no matter what that traction actually is, and no matter how many numbers you might put on the board, at that stage of the business, you're selling to an investor's right brain. You're not selling to their left brain. And so the less you focus on numbers and the more you focus on those three things that I talked about, the market, the team, and why why now, I think that holds you in much better stead than saying we have, unless you have this crazy traction. But other than that, I would say still sell to the right brain at that stage. At some point, you'll sell to the left brain when numbers become a lot more important.
Cool. So I think we're pretty much out of time. If you could all join me in thanking our panel, that'd be great. Karan, Eric, and Michael.
Thanks so much, guys.
Yeah.